I look at some moves that you made, and I see what feels to me like a little bit of nervousness about where we're at. Look at stocks that have gone up a bunch, ones that you own, and now you're trimming Uber for the third time, right? You've sold Iron Mountain, you sold Seagate. Tell me about these moves.
Don't forget United Rentals, Iron Mountain, Seagate, Uber, as you said. So
you trimmed United Rentals.
Right, and this is not a macro call. This is literally like portfolio management 101. You look at your portfolio, you look at the positions, and you say, what's the opportunity cost of continuing to hold this? How much more upside is there from here? So United Rentals, for example, we first added in 2017 at 77. It's up 600%. Historically, it's traded at 10 times. Now it's at 13 times. So we take it down from the 5-ish% position that it grew to down to 3%. Ditto for Uber. On Uber, it's a little like more of a fun story, and we can get back to that debate that we had with Brad Gerstner, where he's saying, look, there's way more long-term potential there. I think I agree with him.
He's not the only one.
No,
right?
he's
not. There are many on this show who own it and say now's not the time to get out, that this thing may be just getting started.
But then there's also analysts who are out there like, putting $62 price targets on it, $66 price targets on it. And as a portfolio manager, you need to say to yourself, if I only have 10% more upside in this, am I doing the right thing by my clients, continuing to hold that? If I think in short order, I can buy something else that over the next year or 2 years has 20, 30, 40, 50% upside. Now let's go to Iron Mountain and Seagate, where those were full exits. Seagate we bought a year and a quarter ago at $56. Seagate is really interesting because when I bought it, like everybody hated memory. This is my third time owning Seagate and making a decent return on it. You buy memory when everybody hates it. You sell memory when everybody's positive on it. So the stock goes from 56 to 80, a 5% yield to an under 4% yield. You take your money, you get out. There's limited upside from here. The valuation's right. The yield's down to under 4%. I am quite certain that within the next month, I'll have something in the portfolio that replaces it with a 5.5% or better dividend yield, because the objective is in this portfolio, right, the equity income one, not the one that has the Uber and the United Rentals, but in the dividend one, it's maintaining this 5% yield or better, so you need to recycle. Iron Mountain, I actually bought in 2015, and it kind of languished for a long time, had a really juicy dividend yield, so I could sit with it. But Iron Mountain, which you all know from the document storage, right, just like you send your boxes of legal documents, they put them in their warehouses. They've also very quietly, and this was always the investment thesis, in the background been building up these data warehouse centers. Well, this year, when data warehouse became extra hot again, this share price was up. What was it up? It was up over 40% this year. And now I've got a real estate investment trust with an under 4% dividend yield in the portfolio. And don't forget, that's not qualified dividend income. So even though it's under 4%, it's really worse on an after-tax basis. Same thing here. Maybe there's upside in Iron Mountain. I'm not saying either of these are bad, but they don't fit the strategy. And I think my upside, even just from sitting in cash for the next month, is probably better on both of these. I've got a nice short list of potentials. I don't know which I'll own, but there are things like UPS, which I've talked about, like Wendy's, like Ford, KeyBank, which I mentioned last week. I don't know which of those will make it in. Maybe it'll be something different. But when I buy those, I will think to myself, there's more upside in that new investment than there was sitting in these.
All right.